Hello and welcome to the Rask Network. What you're about to hear and see is limited to general financial information only. Please be sure to speak to your financial planner or refer to our financial services guide available at rask.com.au/FSG before acting on the information.
Hello and welcome back to the Australian Retirement Podcast. I'm really thrilled today to have a real big hitter in the world of infrastructure for our session, Ben McVicor from Magellan. And thank you so much for jumping on today, mate.
Thanks for having me, James.
We have a lot to get through, but of course the real thing that we want to do in this session is help investors have a better understanding as to what is infrastructure, how it complements their portfolio, and why they should think about it. So let's start with the overarching question, of course. When we talk about infrastructure investments, what do we actually mean? What is infrastructure?
Yeah, sure. Happy to jump in on that one. So when you think about infrastructure, I think there's one element here of infrastructure is exactly what you think it is. It's toll roads, bridges, airports, all of those types of assets. I think, obviously what we're talking about today, though, is infrastructure in the context of investment. And the more interesting point, I think, then to dive into is what actually defines an infrastructure asset. And one of the things that I think is really relevant here is when you think about an infrastructure asset, one of the things it typically delivers, beyond just being typically a lot of concrete and steel, what it typically delivers is an essential service to the community, to the economy, and that really allows our modern world to tick over effectively. And so what you'll tend to find in infrastructure is that the delivery of essential services is really what gives these assets such strong and reliable demand profiles and what makes them such attractive assets for a number of investors out there. And so when you think about what is infrastructure, now obviously everyone's got the different view on, when you actually get to the grey edges of what is an infrastructure portfolio. But when you think about the core stuff of an infrastructure portfolio, you got to find things like toll roads. You're going to find things like airports. You're going to find things like communication towers. So mobile phone towers, which are quite an interesting investment opportunity. And then the other things you'll find as well is typically utilities. So things like gas networks, electric networks, and all of those types of assets that deliver those essential services around the modern economy. So it really is a backbone for delivering services. But what is really attractive is because you've got that just really, really essential service. It doesn't matter if it's in a recession. People still need running water. They still need electricity. So you tend to find these assets have a lot of predictable and reliable demand that's baked against them. There's a lot of details you can get into around that, but that's kind of, the high level is quite simple in terms of what you're doing. You're buying effectively either a freehold or a concession to invest in these assets that give you back a very predictable demand and return stream ultimately.
Thank you. I think reflecting on the time when I've spoken to members about infrastructure or prospects about infrastructure investing, a lot of them are surprised to learn that they probably already have it, right? Like in most people's superannuation funds, if you go and look up the constituents of whatever portfolio you're in, there's a really high likelihood you've actually got a reasonable amount of exposure to this already.
Yeah, that's exactly right. When you think about what's going on in a lot of infrastructure assets is a lot of the superannuation funds have already got holdings in infrastructure assets, and they've been a really sought after investment for a long period of time because of those very predictable demand profiles and the predictable return profiles that come attached to them. So you do find them, a lot of people have exposure to these types of assets more than they realize. And I'd also add that you've also got a number of these, less these days, but you have a number of these still on the Australian Stock Exchange as well. So even to the extent you're in a diversified Australian portfolio, you've typically got exposure to some of these companies. The main one I think that we think about in Australia is Transurban, obviously a very large toll road business dominant on the east coast of Australia, with a very large North American business as well. And a lot of investors, even if they don't have directly through super funds or direct investments there, they'll have exposure to some of these listed assets as well, which are really high quality businesses.
Yeah. I think particularly the fact that, as you said, the fact that you get investments with much more predictable cash flows is something that is really attractive for most superannuation funds when they're looking to achieve that outcome of having predictability of returns as much as possible, but also ensuring that they meet the retirement needs of members and some of those other elements with regular cash.
Yeah, exactly right. Exactly right.
Can I ask, if we think to, like whether it's a transurban or alternatively an alternative fund, I'm sure you'll separate these. How do infrastructure funds make money? Like, where do the profits come from?
Yep, that is a very reasonable question to want to understand. Okay, so when you think about infrastructure, really what you're talking about is the assets themselves. We kind of touched on what the assets are in the infrastructure portfolios. When you think about what, for example, I do is I work within a global listed infrastructure portfolio. So effectively, we build portfolios based upon the listed assets out there on the various stock exchanges around the world. We find those types of assets, in the Australian context, it'd be transurban, but then we do the same thing overseas and we find them in the US, Canada, Western Europe, the UK, and we build high quality portfolios of infrastructure assets that way. The other approach you can see in the market is that you can also find what are called unlisted infrastructure funds. And in that case, the investors will go and actually seek to buy whole assets or stakes in assets directly rather than through the listed markets.
Yes.
And both approaches have pros and cons. I'm not going to sit here and tell you that either way is the perfect way to do it. You can get great assets in both sides. We're very satisfied with the types of assets we find in the listed markets. So from my perspective, when you sort of talk about how does the actual rubber meet the pavement in terms of how do we generate returns in a fund, it's actually quite simple. Because these are listed businesses, ultimately what we're talking about is things like the capital growth of the securities we hold. It's things like distributions. But that's kind of the output. That's not really I think the most interesting piece of this, which is really how the underlying businesses themselves generate those distributions and that capital growth. Because for infrastructure, it's simple, but also somewhat complex as well when you first try to wrap your head around it. I'm happy to sort of dive in that direction, but I don't want to dive in too deep too early either.
Yeah, no, I certainly think we can unpack that as we go, because I'm sure that there'll be some people that would love to learn a little bit more about that.
Yeah.
If we think about an infrastructure fund, the sort of assets that they hold, one of the important things is that you can hold assets at different phases in the cycle, right? Can you speak to that? Like, for example, if you're buying assets or developing an asset from scratch, that has a very different investment profile than buying an existing infrastructure app that's already providing repeatable cash flow.
Yeah, you've raised a great point in the world of infrastructure, which is that a lot of Australians, particularly people who've been in the markets for a while, have seen some of the, what we call greenfield projects or new projects and the problems they've had in the infrastructure space. And that is a very different proposition, investing in a new infrastructure asset like a toll road versus an established transport corridor. So you think about what Transurban's business is today. I'm just sticking as that as a simple example. The majority of those assets are mature toll roads with very predictable traffic patterns attached to them. So you have a really good sense of what is going to happen on that road in the next month, quarter, year. And even as you start to roll out over the years ahead, you have a very strong sense as to the trends attached to that. The big difference you'll find with a greenfield toll road or a new build toll road, it is incredibly difficult to actually work out from day one how much traffic is actually going to end up on that road. Now, there's a really simple way to think about this is if you've got an existing transport corridor with some free roads on it, they're getting pretty full. You then want to go and build a toll road to add some capacity to the transport corridor. The problem you'll immediately run into is you've now, in some instances, doubled the capacity of a corridor. And so in that situation, now trying to work out what the balance of traffic is there, one's tolled, one's not. It's not that in the long term, you don't know what the total growth of the traffic in that corridor is going to be. It's just trying to work out the balance between the various roads can be incredibly difficult.
What are we going to receive off the bat?
You're exactly right. And so in the early days, actually predicting that traffic progression can be quite hard. And then because obviously now you've made the free road a lot better. The second you've added all that capacity to the network, the free roads are now actually flowing a lot better. So people are going to hop back on that road and go, this is great. I now get the free road and I get to move faster. But you watch over time, what happens is that free road eventually gets full again. And then all of that growth ends up on the toll road.
Yes.
And then you'll find that the toll road starts to get a very predictable and steady pattern to it. And we've seen the same thing in some of the toll roads developed here in Sydney, where I'm based, where you've seen initially less confidence around how that traffic develops. But once it starts to develop, you're getting almost all the growth in a transport corridor. So you do get very different dynamics that play out when you look at those various types of phases of development. I'd say in my world and the stuff we look at, almost all of it is developed, mature assets. And in fact, when you look at some of the, that's the toll roads and airports that have been around for a long time, but then a lot of the utilities that we look at as well, these are utilities businesses that, were started decades and decades ago as the world electrified, and they've been running their businesses at a monopoly in the region they run. So there's a lot of history in a lot of these assets, I think. That's, these are obviously, they're still underpinning the modern economy, but they've got a lot of history in terms of how these businesses have operated for a long period of time.
Yeah, wonderful answer, mate. Thank you for going into that level of detail. When we think about investing in infrastructure, for those people listening and considering the merits of that within their portfolio, what do you consider to be the major benefits of infrastructure positions?
Yeah, so when you think about infrastructure and what it actually can give a portfolio, so infrastructure delivers you a couple of things. It delivers you real growth over time. And so the simple way to think about this is if you have a motorway, and we'll stick on that example, and I'll touch on a few others just to sort of flesh out that point. But if you have a motorway, you get consistent growth over time because you get both traffic growth, and once the road's established, you get traffic growth that steadily just grows through that transport corridor. You also get toll price growth. So typically tolls, you will get to increase your tolls by, call it inflation, or inflation plus a bit, which is typically repaying you for capital works you've done on the road. And so over time, that delivers you growth on the asset over time. Now, the same thing plays out whether it's an airport. You get increasing passengers coming through your facilities over time. You benefit from that because you also get paid landing fees for the passengers. You also get paid a percentage of some of the retail sales in a lot of airports. And so you get that growth that comes out of it. But then even in utilities, in mature economies, when you look at some of these utilities businesses, they are continuing to grow. Without diving too deep into this, what they typically do is they continue to grow their earnings by 5-7% a year, just because they're reinvesting, growing the network, dealing with that basically increasing penetration of demand for their services across the economy. These days, obviously, that part for utilities is more about things like AI and data centers. That we're seeing that really driving that part of the market. But you see that ongoing growth. So to bring that back, what you get from infrastructure is real growth. And some of the analysis that we've done over time is that infrastructure shouldn't deliver you broad equity type returns. It's a lower risk asset class ultimately, but it should deliver you absolutely. It should deliver you real growth, or when I say real growth, I mean growth adjusted for inflation, and it should deliver you that steadily over time as well. So that's one of the key things I think that can be missed here, is that it's a real growth asset. The second thing that infrastructure can really deliver you is more defensive qualities. And this sort of ties back to the start of our conversation, which is that infrastructure ultimately it's call it lower volatility, lower drawdown, however you want to sort of think about it. It tends to be a less exposed asset class to the general economic cycle. And so we did some analysis on this recently, looking at effectively our identified investable universe.
Yep.
And we took it back to 2010. And what we found is since that period of time, we went and identified those periods of time when the market fell, and it fell by 5% from the start of the drawdown, or to the bottom at least. And there were about 18 of those. And what we found is that the infrastructure universe, on average, fell half as much as the global equity benchmark when it fell. And so that's just a simple statistic to give you a sense of infrastructure does fall. It's still a risk asset exposed to the cycle. It's just a lot less exposed than general assets out there. And the other point as well that I think is important on infrastructure is that the assets themselves typically have good inflation protection. So before I mentioned it under the growth banner that you get real growth over time after you deduct for inflation. The thing you get here is ultimately a lot of these assets have a good ability to pass through inflation. And so whether that is the tolls, which can typically escalate by some factor of inflation, or whether it's utilities, which can typically pass through all of the fair cost of services to run their business. So you tend to find for many assets in the infrastructure world, you get pretty good inflation protection built into it. So I think that's another factor. Now, I operate in the listed landscape, and as we know, listed markets don't tend to translate. I'm talking about the cash flows of the businesses. Share prices and the underlying earnings of the businesses don't always correlate one-to-one.
Yes.
But you can find there's periods of time when inflation was going up recently and infrastructure might be falling because of interest rates. But in the long term, that cash flow is there. It gets developed. It comes out as distributions from these businesses themselves. So it's another factor, I think, to import on the infrastructure puzzle.
I remember thinking back to one of the earliest investment discussions I had that I can recall with my father, who was a financial advisor, and so obviously pushed me along a little bit particularly in the world of investing. And it hurt my head. I was quite young, but it really hurt my head that in a recession, for example, KFC and McDonald's and some of those sorts of businesses, they wouldn't lose revenue. Their income would actually stay the same or go up. I just couldn't get my head around behaviorally how that would be the case. But it's that concept that those foundational purchases, and will include, if I may, for example, toll road use, and like those things don't change even when financially things get quite complex. So I think when things get bad economically is how I should better say that. And so during, if we're thinking about toll road use, where I'm in Melbourne personally, so thinking about CityLink, for example, the CityLink use does curb, of course, when there are problems economically, because there might be less employment, means less people on the roads. Some people might be desperate to save money and say, no, I'm going to try to avoid it. But the belly of the drivers, the bulk of them, they're still on that freeway every day, and that's a constant.
I think you've summarized that exactly right, which is that it's only a fraction of trips on a motorway are actually for commuting to getting to and from work. A lot of it is still people getting around the city. They're still picking up kids from school. It's all those types of trips, depending on the toll road, that still are in need regardless. And not to mention the fact that in a recession, the majority of the population is still employed. You just have a lower, velocity to the economy. The other thing that as well, a few other ideas sort of popped to my mind when you mentioned the KFC example, which has always been that sort of trade down defensive quality. You get a few of those in infrastructure as well, which is we've got an asset in the portfolio that we run, which is the Euro tunnel that connects. It's the you might know it. It's effectively the high speed rail tunnel that connects the UK and France.
Yeah.
And in that one there, what you tend to find is one of the services they offer is effectively a rolling motorway. You can drive your car up, hop on, and then you go to the other end of it. And so what you'll tend to find is that product, that service, is dominated by people who are UK based and wanting to travel to France for holidays. And so what you'll tend to find is that in a recession, obviously it's cheaper to get the whole family into a car and do a driving holiday to France than it is to get everyone on a plane. Yeah. So it's like you get some of those trade down effects there. We see the same thing in Spain, where there's a bit of a defensive quality, because Spain, again, for the Northern Europeans and the UK market, it's a great holiday destination. But what you'll tend to find in that environment is if it's a recession, people don't tend to want to do the long range, very expensive trips. They might trade down, so to speak, to a holiday to Spain, which is obviously a very short, and with the low cost travel you can do these days, it can be incredibly cheap to fly there as well. So you get a few of those effects that play out in sort of the world that we operate in as well.
Yeah. Can we take a moment to just appreciate what it must feel like to have a low cost holiday to Spain as an option available on the cards?
Yeah, I'm with you on that.
Yeah, that's a world that I could get around. Yeah, okay. And if I may, I think about your role, and particularly that concept of being listed. I imagine that one of the challenges that you could have as having a listed infrastructure investment. Of course, this has a daily share price, and you can follow it. And of course, that means that the performance of it is going to be more scrutinized than with an unlisted asset that might release its unit price once a fortnight or once a month or a different frequency. Is it because of that? And then thinking back to your comment around the unpredictability of immediate cash flows when you have a new project, is it reasonable to think that in most cases your unlisted infrastructure investments are more likely to be doing the developments where they don't have that scrutiny day in, day out, and they can say, hey, stick with us for 12 to 18 to 24 months. This is a longer term or longer. This is a longer term investment for us to get this up and running. And then the money really comes through. Versus if you're in the listed space, there's a high focus on the immediacy of cash flow and justifying the share price via the immediacy of cash flow.
No, I'd say it's about portfolio balancing for these companies. So the companies we invest in, what you'll tend to find is they've all got an element of development and growth attached to them.
Yes.
But it's about having a portfolio. So if you've got 20 plus motorways, they're established and they are in the return phase and they're generating cash for their investment, you can afford to take on a bit of risk in that portfolio. And so that's what a Transurban might do with a new project, is they can then go on and build a project within that portfolio. But to the extent that you wouldn't have them as a 100% of the portfolio or 50% of the portfolio is all of a sudden loaded up on these riskier development opportunities. So I think it's also about having that financial ballast and diversification to manage those types of projects. I know we wouldn't want to go into a space where we're invested in a lot of greenfield projects, but to the extent we've got exposure to a pretty established portfolio with some growth opportunity, and especially from a company with an established track record of doing that very well, that can be a great opportunity to get into that growth opportunity as well. And we've seen, obviously, Transurban's one we talk about here, and I'm sort of bringing it up just for listeners' familiarity as much as anything, but we see similar developments at the moment happening in North America, where the toll road market is far less mature, and what you have is far less penetration of motorways. And the market there, it's probably gone down a different path, where the motorways that are being developed are not like we're used to here in Australia, which is you have an entire road is tolled. Some of the ones we're seeing in North America are more akin to you have an existing free road, and then you build tolled roads to the side of it, tolled lanes to the side of it, and they have variable pricing on them. And what is kind of interesting about these roads is they're somewhat risky to develop, but again, the companies develop them have a portfolio. But what is kind of interesting about these assets is they have variable pricing. So where we're used to having a fixed toll price or a near fixed toll price, in some of these North American roads, what we're seeing is that they are developing these roads so that they'll guarantee for example, 50 mile per hour speed on that road.
Yep.
And the way they guarantee it is by having a variable price. It resets every 5 minutes. So it just increases the price until it ultimately gets there. And so you see some interesting opportunities around development in the listed markets also coming through. And then the only other thing that jumps to my mind on this topic that's worth noting is I talk all about motorways, but utilities are in our space, at least half the world we play in. Yes. And utilities such as electric utilities, they actually have a lot of growth opportunities around, a lot of people think about the shifting energy dynamics where a lot of people are moving, a lot of countries, I should say, are moving away from coal. We're moving more towards either renewable. There's a lot of talk around the world in many countries now about nuclear. And so these utilities companies that we'll invest in, they're very much at the forefront of that. And they're developing their networks. They're developing, for now, things like new solar and wind farm power stations. And as they develop those assets, that obviously provides more growth for those businesses also. So there's growth that sort of happens across there. It's always just within an existing portfolio or an existing business that we're seeing.
Yeah, and I think this. Thank you. I think this speaks really well to the complexity of infrastructure investing and building a portfolio of infrastructure investments, right? Because one element is, of course, finding good projects, regardless of where they are in the cycle. But then another really important element for all of those sorts of projects that you're describing is thinking about what are the global economic conditions or the domestic economic conditions relating to this particular investment, and what are they likely to look like over the coming years, and then how is that likely to flow on? Now, think about, for example, renewable investments, and so many renewable projects have banked heavily on the idea that the cost of coal-generated electricity is going to grow significantly, and that's going to create that arbitrage. I find that really fascinating. That it feels really brave but of course, there's brilliant minds on it thinking about it in terms of where are these prices going to go, and therefore, what does our investment look like? What does this piece of infrastructure look like in 5 or 10 years' time? It's pretty special.
Yeah, absolutely. And that is a huge area of growth across these companies too, because you are seeing, it's whether it's here, whether it's the US, you're just seeing a very strong shift, and you're seeing effectively a wave of investment that's coming through. And, we're talking about the energy transition from the generator side. The other part of the conversation here is obviously the demand side. I feel like maybe 5 years ago, electric cars were something at the periphery and were kind of interesting for a lot of people. But these days, I think everybody knows somebody's either got an electric car or thinking about getting one. They seem like they're just getting more and more traction out there. And so obviously the effect that has on power grids as well is very dynamic. So what you'll see is for example, someone might bring home a Tesla and all of a sudden they've increased their home consumption by an enormous factor. And that adds more load to the grid as well. And ultimately, you think back to what I was saying earlier, who deals with that? It's the utilities companies, it's the power line companies. They have to build the new substations, build a new transmission and distribution network capacity to deal with that ultimately. And we've seen a way, we're kind of at the forefront as well about, and this one sits in between, which is that distributed generation piece. We're about, solar rooftop. And so that obviously requires a lot of grid investment as well, because again, you've got to try to deal with the fact that you've got this intermittent, it's almost daily cycle to the energy demand profile, supply profile, but ultimately that plays out as to a net demand, people just consuming less, power off the grid. Yes. And so you find that tends to play out as well. So the utilities businesses are funny. Everyone sort of thinks about infrastructure and immediately goes to toll roads and airports. The utilities part of the universe is kind of interesting because they are, from the outside, incredibly simple businesses. They're power lines, they're gas distribution networks. But I got to tell you, being an engineer in one of those businesses, I think would be a big job.
Yeah, I can appreciate that. Yeah, constantly changing goalposts.
Yep.
Let's continue on that vein of economic conditions, if I may. What do you perceive to be what are the optimal economic conditions to holding infrastructure investments, please?
Yeah, sure. So generally, the conditions that we've found that infrastructure tends to perform best in is when you've got, call it stable interest rates. You've got reasonable economic growth. Now, as always, when you're thinking about investment, there's how the assets perform in an absolute sense, and then there's how do they perform against what everything else is out there. And obviously, when things are hot out there, and so let's say you have a bit of economic growth that's good for infrastructure. If you have a lot of economic growth and things are pretty hot and racy, you tend to find infrastructure is going to get left behind in that environment. Sure. We're not going to be the types of assets that keep up with the big tech rallies in the US when things are a bit more excited. And so it is a bit more steady returns over time. Mm-hmm. The other environments that you tend to find when it can perform all right is if you have declining interest rates, like we saw over the last decade. Obviously, the last years have been a bit different because obviously there is an element here of these are long duration assets. And because they're lower risk, they do sort of serve that intermediate step in many portfolios somewhere between a fixed income and an equity. You get real growth, but you also get a bit more steady returns out of them. Where they tend to perform more poorly is when you have a rapidly rising interest rate environment. And then that is because it's effectively the flip side of that. It's when you have, and like we've had in the last few years, when interest rates have been, call it normalizing, and we're seeing interest rates really spike up and kind of come back, and they seem for the minute they've found their level a bit around global markets. And in that environment, you tend to find, in a rising rate environment, infrastructure tends to suffer from that. You tend to find share prices fall. Now, I'm always a little bit cautious here because I talk about the share prices, and that's what you get in terms of the short term. But the reality is also what the businesses do, because over a 5-year period, what drives the share prices is businesses, and the interest rates don't tend to impact the businesses as much in the long term. You've got they do have to reset their balance sheet over time, but a lot of these companies have an ability to pass through higher interest costs as well to the consumers. So you do get some protection in the long term, but in the short term, you can find that they tend to fall in that environment as well.
Yeah, thank you. That's a great answer. Well, for your sake and bloody every other Australian, I sincerely hope that we don't have another big rise in interest rates. I think if anything, we're looking up the barrel realistically of things getting better before they get rather than getting worse over the medium term.
Yeah, I think so.
Can I ask, thinking about infrastructure investments, if you're listening to this as a pre-retiree and you're thinking about how infrastructure might complement your portfolio, perhaps you're now actively engaged with your portfolio and you're perhaps selecting some of your own positions, how does this fit into a portfolio? And do you have any sort of rules of thumb as to, as you said before, you wouldn't put 100% of this investment in your portfolio? What feels right?
Yeah, it's a good question. I always find these ones interesting because it is very much, obviously, it's going to be very portfolio dependent. What we tend to see, so maybe I'll step back and just frame my thinking a little bit on this to say how I think about it. But when you think about infrastructure, it tends to be a lower risk investment. And so compared to a general equity, it's got less drawdown, it's more defensive, a bit more reliable in terms of the income generation that comes out of it. And so you get those more defensive qualities. So it can, depending on the portfolio, the individual, it can actually fit into a portfolio nicely, particularly if they're looking for that more preservation of capital, protection of capital, and you're trying to find a portfolio that blends in a bit better there. And so you do tend to find people use it differently. You might find some people put it into a real assets bucket, and it might be, 5-10% of the portfolio, but it really does vary for people and depending on the portfolio and the circumstances.
Thank you. I think that's, I reflect on people that have come to us in the past and said, I'm either a pre-retiree or I'm an accumulator, income increasing quickly, like my wealth is increasing, and I've decided to take control of my own portfolio. And I reflect on looking at these self-made portfolios. It's very rare to find an infrastructure position within these self-made portfolios. At best, you might have a VAP, Vanguard Australian Property, or one of these sort of assets, or shares, I beg your pardon, ETFs, but incredibly rare that people would consider this, in my experience. I think that if you're listening to this and you are in that vein where you would like to take more control over your portfolio, there's a lot to be said for trying to still achieve good, healthy rates of return that ideally are somewhat inflation-proof or certainly inflation-protected, but all the while ensuring that when we do have those periods of stormy weather, which do come through in portfolios, you don't experience that huge volatility. And especially for pre-retirees, that becomes more and more important to ensure that you're achieving that combination of getting a really good rate of return that's going to grow your asset base and hopefully position you for a comfortable retirement, but not take the beatings when we have that big market event that really rocks equity portfolios. As you identified a little bit earlier, Ben, you're much more likely to perhaps have a smooth ride when you've got infrastructure exposure through your portfolio at that time.
Absolutely. Yeah.
Ben, this has been great. Thank you very much. The last thing that stands out to me, please, is about Magellan. If you're listening to this as an investor and perhaps taking control of your own portfolio and considering the merits of infrastructure investing, why would Magellan be somewhere that they should turn?
Yeah, sure. So infrastructure, as I've just talked about, infrastructure, there's a lot of different assets out there. I'd say that when we actually work out what we want to have in the portfolio and the types of assets we want to hold, we're pretty conservative. Infrastructure is a pretty conservative asset class, and I'd say within that, we're pretty conservative. It's an intentional decision, and we're not, worried about taking risks. We just want to take the right risks. And so what we tend to do is have a very core portfolio of infrastructure. We've been doing this now for about 17 years as a team. And we've got a team of 8 of us involved who have worked together now for, I think at minimum, the newest member of our senior part of the team is about 8 years ago. So we've got a lot of experience in this space. And I'd say our particular approach tends to be, as I say, that very conservative, I'd say more reliable, steady returns is our target. And I'd say because of that, that's going to suit some portfolios, and there's going to have some investors out there who might want to have something that's a little bit more exciting than that, and you'll find that might be fit into a portfolio differently. But we tend to be pretty defensive holdings for portfolios, which I think, from our perspective, and we've sort of just touched on some of what infrastructure does in a portfolio, but some of the things that you just outlined is defensiveness, inflation protection. They're really the key tenets that we're trying to exemplify with infrastructure. And you can kind of get a little bit too excited, I think, sometimes going to the edges, and you start to, that sort of naming any particular assets, you can get to the edges and start to invest in stuff that doesn't really have that protection. The next time the economy has a slide, you're going to find that you don't get the protection you expect out of those assets. They're just not that robust, tested asset. And that's really what we're trying to stick to, is just through the cycle, stick to our knitting on that approach.
Fantastic. Well, mate, thank you so much, Ben McVicor. I really appreciate you being on the show today. It was really valuable to get your insight. So thank you.
Thanks for having me, James. It's been great.
And ladies and gentlemen, thank you again for dialing into the Australian Retirement Podcast. We hope you took a lot from this episode, and we will be getting a lot more great content to you guys in the future. So stay tuned.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.